So, Alf, I think we are live now.
We should. Hey,
We
Soren.
should be. How are you?
Very good. Thanks for having me. Pleasure to be with Koera today.
Thank you so much. We've been looking forward to this, Alf, and I particularly have been looking forward to listening to your new venture as well. As you know, I've been on the same path. I've been inside investment banking and been trading myself, and I've been following your research. You and I have been talking over years about your research. Obviously, I follow the macro compass like 500,000 other people on regular basis. I've also spent many Sunday mornings with you and Andreas with my espresso that you taught me how to drink. So thank you very much for coming on here. I'm really looking forward to it. Thank you for everybody who's joining.
Yeah.
And first, I actually need to do some housekeeping. The regulatory constraints and everything we need to process here, with a disclaimer that none of this information should be considered as advice, and people should do their own research. They should consult an advisor before they take any investment decisions. We're really to discuss the markets today, and I think that's a good place to start. As I mentioned earlier, obviously I followed your macro framework, and I really enjoy that. Not necessarily everybody who's on here knows your path and your experience before starting that research firm. So maybe you will give us just a brief introduction and we can go from there. Is that fine?
Sure. So, buongiorno, everyone. I am very Italian. Probably my accent gave it up already. Full name is Alfonso Peccatiello. Probably you know me from Alf if you follow social media somewhere else, or Macro Alf or whatever you. I was born in the south of Italy, deep south of Italy, about 33 years ago. Went into finance at 14 years old. How is that possible? My mother is the treasurer of a small Italian bank, which meant I was immersed into BTP futures chart since the age of 14, basically, which was an interesting experience because I was always a curious guy. So wanted to know what the hell is that. So I bombarded my mother with questions, became passionate about it, then studied finance and ended up at ING, a large European bank, global bank, mostly European. Worked there for 8 to 9 years. So what I was doing there in my early stages of my career was an analyst in their treasury department, trying to figure out macro and the impact of macro on the balance sheet of the bank. That was my first role, which then evolved into a portfolio management role, mostly for government bonds, which is a very large portion of the treasury book of any bank nowadays for regulatory reasons. And that went pretty well and evolved into being the head of investments for ING Germany. So that's the largest subsidiary of the bank, $20 billion portfolio, fixed income, derivatives, credit, at later stage of the mandate, also equities and FX as well in there. So I ran that investment book for 3.5 years. And then by the end of 2021, I decided that I wanted to do something by myself, which was quite the leap of faith. My wife wasn't particularly happy about it, but I still went ahead. And I decided to open up my shop, which is called the Macro Compass, which started as an advisory for hedge funds and institutional clients mostly. So they knew me from the previous business, and I was doing macro advisory for them and running my own money, basically. Also an entrepreneurial decision, to start something mine. Was very fun, and then it became something else also because I started sharing my views on social media. For some reason, it became pretty popular, and so the Macro Compass has grown to be also a bit more retail friendly, not only a purely institutional platform. But this has been going on now for 2.5 years, and already after the first year, a few investors had reached out to say, "Alf, there is a large amount of macro vol." That was 2022. So would you want to consider starting the fund, or what are your thoughts on that? And back then it was a bit early because I was setting up my company, but now I would say it's not that early anymore because the company is well set up. Macro vol is still there, and I think it will dominate the next decade as well. And that is why I'm ready and setting up a macro fund as we speak.
Fantastic. Thank you so much. I appreciate that. That took a bit leap forward. But I think today we would like to have an agenda that involves a bit about the market scenarios we have right now. I know that's the majority of your time that you spend on analyzing the macro framework.
Yeah.
Later, I would like to come back also to your fund, because as I mentioned, I've been also part of that transition, but 2 decades ago, and there was no social media to distribute the research. It was really email that was been done for a year to engage with the institutional investors that we had and later raised capital from. But maybe we should start just with the macro framework. Maybe you can paint the picture of where we are right now.
Yeah, I think the Federal Reserve meeting of yesterday, as we're talking on March 21st, yesterday there was the Fed meeting on the 20th. I think it really showed what the Federal reaction function is. And I made a joke with a few clients that it used to be a dual mandate of maximum employment and stable inflation around 2%. And today the dual mandate seems to be cut rates before elections, whatever the conditions are, and send stocks to the moon, with the side effect of sending also other assets like crypto or meme coins called the Joe Biden as well, going up 9,000% in a weekend. So basically, the Federal Reserve yesterday showed their hand. Their hand is that despite having a core PCE forecast at 2.6% by the end of the year, which is nowhere near 2, to be frank, it's 2.6. That's their own forecast, which is being validated by 2 bumpy core inflation prints in January and February. Despite that, and despite financial conditions loosening in markets, they are going to go ahead with 3 cuts this year. That was the main message yesterday, together with the fact that they even see a neutral interest rate higher. They finally moved the long run dot of their dot plot a bit higher. So they are starting to recognize that something might have changed structurally in the US economy. Nevertheless, Soren, they're still going ahead with 3 cuts. And as the economy is still doing okay, then the result is obviously you put further fuel on the fire of these animal spirits running loose already.
But is there also the risk that this is basically just kicking the can down the street? You know, there's been speculations in the market about how many rate cuts and when they will start, and it ended up being discussion of higher for longer. And for some reason, there's been this obsession about when will the rate cuts come. There was about discussion about a hard landing versus a soft landing. Now, will it even land? We just had in Denmark, I know it's not a big indicator for the rest of the world, but they just put the GDP growth expectation 2 days ago up from 1.3 to 2.4%, which is a significant adjustment on an outlook for that's for 2024. Is there a chance that they are just, you mentioned the election before, that it's more something, okay, we would like to have the benefits from expectation of lower rates, and you have equities to the moon,
Look, I think
without having to deliver on it?
Yeah, I mean, the right word you're using here is chance, odds, probabilities, because at the end, as an investor, but also as a policymaker, you don't have a crystal ball, right? So all you're doing is try to skew the odds in a certain way or another. And talking about odds, if we can put the slide on the screen here, I wanted to show the listeners a bit of my some of my models that I run to get an idea of what the bond market is thinking here. Because you mentioned economists, Soren, and on economists, we all know that they are now picturing the perfect soft landing. That's what's priced in from an economist consensus point of view. And namely, GDP growth in the US this year, according to economists, will be 2% real, pretty respectable GDP growth. You're going to have 130,000 new jobs added a month, which is more than enough to keep up with the labor supply in the US, so that unemployment rate will not go higher. And you're going to have core PCE at 2.2%, kind of in the ballpark of 2. So economists are basically saying, this is perfect. It's the perfect soft landing. The bond market was a bit more skeptical about these probabilities, but now it's not really that skeptical anymore. So here on this, on the video, on the slide, we can see a model that I use to derive market implied probabilities from the bond market for different scenarios. And how I do that is I look at options that are underlying the SOFR future contracts. So in this case, I went 1 year ahead. I took the 1 year ahead SOFR future contract, and I looked at options underneath these SOFR future contracts. And this tells me how bond option traders are positioning for different scenarios. So what is the probability they're attaching to a certain scenario? It's a very interesting chart because you can see that basically, let's start from the blue line, the lowest one, that's recession, which would mean the Federal Reserve has to cut rates by 200, 250 basis points in a year. That's consistent with historical reaction function of the Federal Reserve to a recession, okay? That probability today is 7%. So now a recession happens on average once every 10 years. Let's say if we take the last 70 years, that means in a given random year ahead of you, sir, and you would have a 10% ex ante odd of a recession hitting, okay? Once every 10 years. Now, if you consider that you have raised interest rates rapidly and you have kept interest rates very high, you might want to make the argument that without knowing anything else, your recession odd the year forward should be maybe 15, 17% right now, I think, just randomly. The market is at 7%. So basically they're throwing in the towel of any idea, of any risk, of any odds that we're going to have a recession at all. And what is the winner of this probability game is soft landing. Now, soft landing got priced at some point to be an 85% probability. So basically a done deal, right? And look, lately though, there is an interesting development here. So recession gets priced out, but also soft landing is getting priced a bit lower. And who's the winner here is the red line. The red line is higher for longer. So basically, I think what we are looking at here is a bond market that is saying, okay, so if the Federal Reserve is gonna maybe proceed with a few cuts this year, what happens after that is they're gonna fuel this nominal growth story by accommodating now when the economy can still hold it pretty well. They are effectively giving further fuel to the fire, maybe even for an acceleration of inflation down the road in the second half of the year or in early 2025, and therefore raising the odds that we are really going to end up in a higher for longer scenario. I think that's what the bond market is saying today. And I find this picture interesting because when you disentangle scenarios from the bond market, you get much more information than just looking at a single yield. And today, I wanted to show the audience that this is the set of information that the bond market is working with.
Okay, so thanks for sharing that. There is a bit of divergence between the U.S. economy and the rest of the world. We have seen, I think, Swiss National Bank is starting to cut. We have seen Bank of England is softening. We've just seen Bank of Japan hiking for the first time. Let's just stick with Europe first. There's a huge divergence between Europe and the U.S. How do you see that play out in the bond market? Because if you should have a portfolio right now, whether you're just trading your own money or your fund comes up there, I mean, you have to choose between your allocations.
Yes.
Where are the biggest opportunities and who leads who, basically?
Yeah.
It would be one of the first times Europe would be the leader of interest rate policies, right?
Yeah, I mean, the situation is the following. All central banks in the world have tried to mimic what the Federal Reserve has done, right, by hiking interest rates pretty much on a one-on-one basis, okay? So Europe didn't hike to 5%, but they hiked from negative rates all the way to plus 4%, okay? Even countries that were thought to be just, impossible as a potential scenario to hike rates, like Sweden or Switzerland. Remember, like in 2019, it wasn't even a thing that Switzerland or Sweden would ever hike interest rates. They have hiked interest rates north of 2%. And now even Japan is hiking interest rates, okay? Why am I saying this is that all central banks have tried to follow the Federal Reserve in the hiking cycle, okay? Maybe not to devalue their currency further because we were having a global inflationary impulse. And in that case, in 2022, for example, you don't want your currency to devalue, right? Otherwise, you're going to add further fuel on the fire. So if the Fed is hiking, you're somehow forced to follow through. What's the problem there? Well, that the reason why the United States has been able to handle higher interest rates without much damage so far is that the structure of the US private sector this time is quite stronger or more equipped to handle higher interest rates than it was, for example, prior to the great financial crisis. But that is not true at all for other private sectors. So here come a bit of macro opportunities around the world. First, let's clarify why is the US private sector more equipped to handle higher interest rates. There are basically three angles. It's pretty simple. The first is that if you look at private sector leverage, so basically corporate and households' debt as a percentage of their income or as a percentage of GDP, if you look at 2006, in the US, you were north of 170, 180%. If you look at the same number today, you are at 150%. So basically what has happened after the great financial crisis is that the US private sector said, whoa, I was too levered. This was a big hit on the housing crisis, especially. I'm going to deleverage going forward. And the government of the United States picked up the baton of levering up, right? That's what has happened in the US. Can you say the same about Europe? Not really, because we have been doing austerity no stop between 2013 and 2019. So the government didn't pick up any baton at all, and it left the private sector where possible to find ways to lever up and get access to credit, okay? So in Europe, you can't say the same. Same for Sweden, same for Switzerland, same for other countries. You cannot say that the private sector has deleveraged, which is something instead you can say in the US. Second point, in the US in particular, the economy is very financialized, which means also households and corporates are very active and smart and attentive to financial markets, which means that in 2019, 2020, and 2021, US corporates and households have secured long-term funding at very low interest rates. They've locked it in. You have had a corporate issuance of the highest level of average duration that you have ever had. So in other words, companies came in and said, 3% yields for 30 years, you can give them to me. And they lock them in, right? You cannot say the same to the same extent for other jurisdictions. Maybe also because, for example, in Europe, most of the credit to corporates happens through banking, not through capital markets, okay? So we have a strong lending activity in Europe, while in the US, bank loans to corporates represent only 20% of corporate financing. In Europe, they almost represent 50%. And bank loans are often linked to Euribor. So they're floating rate based, which means that the corporate can borrow through bank loans. But if the ECB hikes rates, they are going to feel the pressure immediately, which isn't the case in the United States. And third, refinancing cliffs. Because the other thing that really matters is, Soren, if you think about it, how does a hiking cycle, how is it supposed to impact the private sector? Well, if I raise mortgage rates from 3 to 7% and no one needs to refinance their mortgage, who cares, right? It doesn't matter. But if instead a lot of people are caught into refinancing their mortgages at 7%, they have the same salary. A lot of their salary will have to be allocated to paying debt servicing costs. Same for corporates, by the way. Their earnings pie will be more allocated to that, which means less allocated to capex, to spending, to hiring, et cetera, and therefore the economy slows. But if the refinancing cliffs are pushed further out in the future, which is the case for the US, but it is not the case for Europe, for example, then you will see the US economy more able to handle that than Europe is. And that's why the discrepancy. That's why you're seeing countries like New Zealand, Canada, Europe, Sweden, UK, and I'm not mentioning names randomly. We will put up a slide in a second that shows my vulnerability framework. That's why you're seeing these countries showing up much more cracks than the US is at the moment.
And how would you play that if you looked at it as a portfolio manager and less as an analyst at this time? I mean, would you just focus on the US bond market, or is there opportunities in the European market? Or, I mean, you would have to choose. Yeah. Of course, you can have multiple positions on, but where is the biggest opportunity here if you look at it from a trading perspective?
So I would say that if we put up the slide for a second, I can show a chart that leads to the answer to this question. Let me get the slide that I'm looking for. Yes. Okay. So this chart is basically the outcome of the discussion we just had. On the x-axis, you can see my country vulnerability indicator. So the more you move to the right, the more a country is vulnerable to higher interest rates. Yeah. And the more you move north, the more you will have this country which has tried to imitate the United States by raising interest rates aggressively. So you'll have the UK or New Zealand very high up because they've raised interest rates north of 5%, for example. okay? And Japan and Switzerland very much down because their hiking cycle was much more shallow, okay? That's how it works. So then you have to focus on the top right to find the weakest links. The weakest links are the most vulnerable countries that have hiked the most, okay? And then you look at this bucket and you come up with UK, New Zealand, Europe, Canada, and Sweden. All these countries, by the way, are having GDP growth already today, flirting with the 0% area, roughly, anywhere between 0 and 0.5%. So they are showing already cracks, okay? So how do you play this? Well, as a macro manager, one of your advantages, Soren, is that you can put up trades that are idiosyncratic. They don't necessarily need the equity market to do X or the bond market to do Y, but you can cross two countries versus each other, for example, via a currency trade or via a relative value trade in two different interest rate markets. So a trade I've had on now for a bit is buying Canadian front-end bonds and sell US front-end bonds against it. So the idea is that ultimately the market will recognize that a fragile country like Canada needs to cut interest rates faster than the US needs to. So there, as a macro manager, you can isolate situations where you make money betting on these relative value ideas. And so your portfolio isn't directional. You aren't taking risks on where the beta goes, where the market goes. You are selecting opportunities based on a framework. And in this case, Canada or Sweden or Europe as well, which even today, Europe is priced to unwind the same percentage of the previous hiking cycle than the US. So if Europe hiked from minus 50 to plus 400 and the US hiked from 0 to 525, if you look at the cuts priced in over the next 2 years, in proportion of the previous hiking cycle, they're roughly the same. And you might want to make an argument, Soren, for which Europe will be forced to unwind more than the US will be forced to unwind. And so there are a few ways to express this. You can do it in the currency, you can short the euro and you can buy the dollar, you can do it in interest rates with each other, or you can select European interest rates and buy some options. And going back to the chart of the recession probability here, for example, if I would draw the same for Europe, it will look very similar. Europe will be priced to have only an 8 to 10% chance of a recession in a year from now. And so you can think, well, if they're vulnerable, they should be priced at a higher probability. Sure. And then you can try to put up trades that are benefiting from these discrepancies.
Okay, fantastic. So if we try to link this to running a portfolio or a fund, you mentioned that you can do it through an FX position, or you can do it straight through interest rates. So the mandate you want to obtain from the fund, is that going to cover the entire spectrum of the investment universe, or what will you focus on?
Yeah, so the fund is a global macro fund, which by definition means that you're supposed to be able to exploit opportunities wherever they pop up. So that basically means you are going to be trading the most liquid asset classes out there. That is stock markets, currencies, commodities, and foreign exchange. Okay. So again, you can trade this in FX, or you can trade that in interest rates by buying a certain bond market and selling another one. And you will be screening multiple geographies across asset classes to make sure that you can identify these opportunities. Why do I think they matter right now is exactly because we are at a point of the global economic cycle and a point, let's say, a structural change, let's say, in a few things that are really important for the stability of the system. For example, demographics. You have China that have added about 300 million workers over the last 25 years. 300 million cheap workers that the West has clearly outsourced manufactured jobs towards, right? That's what we have done. That's how China built their business model, and that's what we have found convenient to do for the last 20 years, okay? But the model in China is not only breaking, because there has been further influx of cheap workers, for example, from Pakistan or Bangladesh or Vietnam, etc. So they found competition. But what's happening is that if you look at the demographics in China, you will realize that over the next 20 years, the Chinese workforce will shrink by 200 million workers. So what does it do to the global labor supply? What does it do to this idea that we can cheaply outsource labor and get the best of the disinflationary growth out of it? It will probably be challenged. And so that leads to some more inflation volatility, for example, because demographics are changing. And if I can put back up the slide, I think another set of opportunities comes from having the use of fiscal deficits being completely different to what we're used to. So this is the chart. And I think this is very key for people to understand, Søren, because we used to have politicians in the US that used budget deficits. They are in orange in this chart, okay? Yeah. They used to use them in an anti-cyclical way, which means if the economy, unemployment rate is in blue, if the economy was weakening, so unemployment rate was going up, they used to scale up their deficits. You see, that was basically the drill before. And then when the recession was resolved, basically, and unemployment rate started going down, they would also scale down their deficits. You know, they will tighten the belt and they will say the economy doesn't need it. I will be using deficits anti-cyclically, basically to fight economic weakness. But then in 2016, something changed. Trump got elected. Biden, by the way, is doing the same right now. So this is not a political statement. It's just a change of the way we use deficits in general. Unemployment rate under Trump was going down, below 5%, and yet it was scaling up fiscal deficits. And now with Biden, it's even more impressive, with unemployment rate at 4% and fiscal deficits running way north of 5% structurally. And then you have to ask yourself, if you keep using fiscal deficits pro-cyclically, not anti-cyclically, so sometimes putting fuel on the fire of a hot economy, what is going to happen? Can you push money velocity higher? A couple of times, money velocity has peaked above, positive levels. In other words, this chart shows you whether printing $1 of debt generates more than $1 of growth. You're going to be on the wide end. If you are suboptimal in printing money, which we often are, then with $1 of debt, you're going to generate less than $1 of growth. That is mostly the case. But sometimes you have had episodes, for example, in 2021, where you have printed a lot of money, you were reopening the economies, and so money velocity picked up. And so that $1 of debt you have created generated more than $1 of growth. But then it always reverts down because it's not a structural change, it's just a cyclical event. Now, this time we're again popping up above this excess money velocity level, and you have to start wondering if this is going to happen over and over and over again. Will there be a point where inflation volatility starts picking up? And if it does, what is going to happen to bond markets, to currency markets? And this is why I think a global macro strategy makes sense for the next 5 to 10 years in a portfolio, because it is equipped to be nimble and take advantage of all this macro volatility, which I think is upcoming.
Fantastic. All right. I can see we have started to get some questions. I think, I'm sorry I didn't mention that at the beginning, but of course we have opened for Q&A. We will, in the later part, we're scheduled for about an hour. So we have about half an hour still to go. I think most of the questions we will take in the last 15 minutes. If there's some of them that are relevant for what we speak about right now and you don't feel it will interrupt, please, you can see them, right, Alf? Can you see the questions?
Yeah, I can see the questions. There are a few coming in on China, which is a hot topic for me. So very happy to talk about that.
Yeah, so maybe that's a place we can go if you're comfortable with it right now.
Sure.
So yeah, let's go into some questions. We can come back. I would like to speak a little bit about your fund, your timing afterwards. I've noticed some of really brilliant macro traders from the past who retired, maybe had some difficult years because macro had a pause at some point, but they are returning now, and maybe it could be interesting to discuss if there is a setup that is an opportunity right now. But we can come back to that. So let's try and see. There was one about China, where it is on the vulnerability chart, do you have any comments here?
Yeah, so in China, I think we should discuss for a second, where does China stand overall in their economic cycle, long-term economic cycle. So to do that, I'm going to summon again my slides. I've prepared quite some charts to back up my macro narratives. So for China, that is, I think, one of the key charts. So before, I used to talk about how private sector debt as a percentage of GDP in the US is today lower, as you can see here, than it was before the great financial crisis. You see that? So this used to be higher, now it's lower. So the US is, a bit more equipped than it was back then to handle higher interest rates. Can you please have a look at China in this chart? So China has levered up their private sector over the last 20 years from 100% of GDP to 220%. That is a ridiculous amount of leverage being added in the Chinese private sector in only 20 years. It is hard to find any other examples in history where only in 20 years you were adding 120% of private sector debt as a percentage of GDP. So this is an incredibly fast leverage that China basically put up, especially after 2007, 2008. Why did they do that? Well, here they were levering up their private sector, but in a very conservative and slow way, because they had other ways to grow their economy. They didn't need all this leverage, CERN, because they had young demographics. They just joined the WTO, by the way, and that unlocked for them in the early 2000s a big market for their exports, right? So they were enhancing productivity and they had a younger demographic. And so that worked. So they did a bit of leverage, but not so much. But by 2008, 2009, most of these structural improvements had already played their growth potential into the Chinese economy. And so China had to figure out other ways to grow fast, right? And what's the other way to grow fast? Well, of course, is to lever up your economy. And so the property sector, basically, and the tech sector were the two most beneficiary sectors of this high leverage. Now, there is a problem with that, obviously, which is that in normal times, the private sector likes cheap and ample and available leverage. So how it works is that there is a process of credit creation where a bank here will lend money. So it will create a new loan, basically, or a mortgage, for example. And the private sector, as long as that mortgage is cheap, that loan is cheap, will show up and say, yes, sure, give it to me. I'm going to go and buy a house. Okay. So the entire economy will basically lever up on the availability of cheap credit coming from banks. And it's a virtuous cycle as long as the assets that are underlying this loan, so let's say house prices or anything else that is the collateral of this loan, stays there in price or possibly goes up, right? So you create new credit cheaper and cheaper. The assets that you're buying with new credit keep going up. Everyone is happy. Now, there is a problem in this. The problem in this model is that historically, every time private sector debt to GDP in every developed economy, also emerging markets, has crossed 200% very rapidly, you have always had the situation of an indigestion of private sector credit, which in the system becomes very fragile. Because once you start raising interest rates or the price of collateral goes down a little bit, then the system is too leveraged and too fragile, and you start going into deleveraging and ultimately, in some cases, into a balance sheet recession. This was exactly the pattern that Japan took in the 1990s. So in the 1980s, Japan levered up their private sector aggressively. We had a housing bubble. The Imperial Palace of Tokyo was worth more than the entire state of California real estate. I mean, this is ridiculous, but this is the level that we reached back there. Everybody wanted to have Japanese real estate and Japanese assets, but then at some point, the Bank of Japan said, well, this is becoming a bit too hot. I'm going to raise interest rates to try and calm down things. Well, they did not only end up in calming down things, they ended up bursting one of the biggest bubbles in history. Okay. And Japan took about 25 years roughly to recover from it. And maybe now we're seeing it. But so China, coming back to the slide, has effectively done the same by trying to delever orderly their property sector. So at some point in 2021, Xi Jinping said, enough, this is a bit too much now. I mean, common prosperity and this mantra in China isn't supposed to be house prices go up like a casino 20% a year. That's not what he meant with common prosperity. So he tried to, tighten up the grip. The problem is when you tighten up the grip on an asset class, which was valued at the end of 2021 to be worth $50 trillion, that's more than the market cap of the US stock market. What? At that point, when you try to delever that market, even orderly, that doesn't work. So basically, the regulation that he put on property developers, for example, trying to tighten the belts on the housing market, ended up causing more damage than he thought. And in particular, at the end, what is known to be a balance sheet recession. So a balance sheet recession works pretty much the opposite way of creating credit. So if you follow a bit the arrows here, you will understand how it actually works. So basically, you have a situation where banks have generated loans and the private sector has taken these loans on and they've bought houses, in this case, assets which can be houses or stocks or other assets. And what happens here is that if you have a deleveraging process and these asset prices start dropping a bit, right? So you have the property developers failing, like Evergrande, they can't finish your apartment, you have already taken on a loan, but your asset start going down in prices. Well, what happens is that you will not have anymore any appetite to take on more credit. It won't show up anymore because your credit is already underwater.
Sure.
Now, if you keep doing this and your asset prices keep dropping down, your only way to repair your balance sheet is not by getting more leverage, but actually by paying down your existing debt. So you will rush basically to shrink your balance sheet, which is the opposite process of growing your balance sheet, which is what the normal, healthy private sector credit creation process works like. And now, what is China doing to stop this deleveraging, where everyone says, I have too much debt and my collateral value, my asset value is going down, and therefore they try to pay down their debt, and therefore they sell the houses, and the collateral value goes down further, et cetera, et cetera. It's a rolling snowball. What they're doing is they're cutting interest rates. That is what China is doing today. Chinese third-year government bonds are at the lowest yield ever as we speak. So China is cutting rates, which is exactly the same that Japan did back in the 90s. So Japanese interest rates, I think I should have, that's an interesting chart. As you can see,
that's when dollar yen bottomed at the same time.
Yeah, correct. So what is happening here is, as you can see, early 90s, this was the peak of the Japanese housing bubble. At some point, though, here house prices were going up. And in the 90s, the Bank of Japan said, no, we have to do something here. This is too much. And so they raised rates and Japanese yields in orange went up. And you can see at some point this caused trouble in the housing market. And we started the deleveraging process. House prices went down, down, and down. But Japan immediately reacted and they said, no. We didn't mean to destroy the entire thing here. We just wanted to calm it down a bit. So they start cutting interest rates. And Japanese bond yields went from 8% in 1991 to 1% in 1997. I mean, they cut rates basically to zero. They started doing the first operations of QE as well in the late 90s in Japan. Okay. But what happened to Japanese house prices in the meantime? Would you expect that with Japanese bond yields at 1%, the housing market would stabilize? No, sir, it wouldn't. Because once the private sector is hurt with the deleveraging process and they see themselves forced basically to pay down their debt, to sell their houses, you can't make them get on more credit, even if rates are zero. This would be akin to going to someone who's puking because he ate too much with a cake. He won't get the cake, he's puking. That's basically what's happening. And in China right now, we are in a puking process. The private sector is deleveraging, and the Chinese authorities aren't coming in with fiscal deficits, which could be a way to help the private sector, to help these developers. They're coming in with a medicine that doesn't work, which is cutting interest rates. This combination certainly is quite scary for me, because if it's true that China has capital controls, that means the direct impact of Chinese weakness through financial markets interconnections is pretty low by design of the Chinese system. What is true is that China is a big injector of foreign direct investments in certain economies. Australia, Brazil, all the Eastern Asian economies, they are big recipient of Chinese foreign direct investments. It's a big portion of their GDP contribution. Well, if the Chinese economy keeps deleveraging, you can guess that China won't be busy investing in Australia, investing in Brazil, and investing in Eastern Asia. So they will be missing this flow of money, really, and this might have reverberation in economies that, start to be large enough to manage. And also China is a big trade partner of Europe, for example. So something definitely to consider there.
I just understand from my wife just came back from Japan, and she's an architect, so it's a completely different industry. But obviously that's related to the property industry, and it's very attractive for Chinese private institutions to purchase pretty lofty prices in the Japanese real estate market already. So there is some capital that is still floating. There is one question from Henrik Mikkelsen related to what we discussed here, whether this should not be an FX trading opportunity. And I don't know if you have an opinion here. I mean, we talked about historical with the Japanese interest rates going from 8 down to 1% and actually to 0 and below as well. At the same time, dollar yen went from 250 to 85, right?
Yeah, I remember
And
that.
they were complaining for almost a decade about it was impossible to actually support the industrial export with that strong a currency. And even though obviously many manufacturers has done very well. So how do you see this? I mean, we talked about China as well. Is the trade in
I mean, the FX market certainly is pretty sleepy as we speak. Implied volatility in many pairs is heading towards the lowest levels over the last decade again, because it was pretty sleepy as well before the pandemic. But I think it's just a temporary slipping pattern. I mean, FX will be, again, a lively market. It's one of the markets that will be trading in the fund, because FX allows you to express in very interesting ways these discrepancies and these relative value opportunities we are discussing. And I think it will be one of the most interesting asset classes out there. So one of the processes I have to determine whether FX or interest rates are the best way to express it is you can indeed look at the valuation, for example, of different interest rates with each other. You can develop models to understand whether an FX pair is a better way to express a certain idea, but definitely FX will be one of the asset classes that is the most fit, let's say, to express global macro ideas.
Well, one of the things I really enjoyed on Sunday morning when I had my espresso with you and Andreas was actually that you were extremely specific with some trade ideas every time. And you had this critical thinking that not only did you express your a certain market call, you also looked at obviously the risk factors, but when are you wrong and how could you look at it differently? You even did it to your guests. I remember when sometimes they had left the interview, obviously it was not live, but then you had to go over their trading ideas. So if we should just, without having necessarily a specific trading idea, but if there was a market that you should corner right now, given these discrepancies and divergence in between the U.S. economy, between to China, to Europe, is there any currency pairs that you feel there is something that you would look deeper into?
I would say that right now the downside in sterling or the downside in euro is offered pretty cheap against the dollar, for example, or against the Norwegian krona, which is a long leg that I really like, to be honest, because I think it's one of the few central banks that is credible enough to be able really to handle higher rates for longer. But I think the downside specifically in euro and in sterling is offered quite cheap. And the reason is that nothing has been happening basically since the UK budget debacle and the pension crisis of late 2022 there was, and the European energy crisis, roughly the same timeline. For a year and a half, nothing has been going on there. So basically you have been paid to sell these tails. You have been paid to sell this optionality. People have become accustomed to that, but Europe and the UK are both showing signs of economic weakness. And even stuff like the Swedish krona today, if you would buy downside on the Swedish krona against the dollar, it's offered pretty cheap. So I think these are opportunities to keep in mind, because you don't pay a lot for the ball, and you're targeting currencies that are whose economies are structurally more exposed to higher interest rates than the US or Norway, for example, is.
Okay, so would that mean that you would typically look at it through an option strategy?
We at the fund, we have a framework to basically assess whether buying options makes more sense than operating linear. And it's pretty simple. Options are expensive, and therefore you should try and assess well ex ante why are you using options. There are only two ways in my framework that using options makes sense. The first is if you're trying to disentangle a certain payoff. So you're only interested in a certain particular payoff, then options sometimes can be very helpful in structuring a trade idea like that. The other is if you are offered convexity pretty cheap. So that means if markets are underestimating the, let's say, potential path ahead, especially when it comes to how fast it can develop,
Yeah.
because they're offering basically the convexity chip. That doesn't happen very often, by the way. That is, I mean, markets have become very smart, I think, at pricing options, but it is something that we apply looking at these two angles. Am I identifying a certain payoff? Am I offered convexity cheap enough? If one of the two is true, how do you size an option? Because being long options, being short options is a way to be often right, very often right. But then when you're wrong really, really bad. Okay. Yeah. And that's not what I do. I only buy options in the fund, which means that if I buy out of the money stuff, for example, I won't be right very often, okay, with options. So you need to make sure that the amount of capital you spend on these options is also appropriate given your ex-ante odds. All of this is all embedded in a framework that we have built.
Okay, fantastic. I think we have a lot of questions. And actually, I did, when we announced that you were joining, I also offered that some people could send me questions. Sure. That I could bring to it. And there's a risk to the first one here because it's related to bonds. And you might not be aware, but Denmark is a bond country. Historically, people were buying bonds. Head of family offices are typical fixed income traders or bond traders from one of the institutions. It's very different from Sweden, which is just next door, and I can almost look over there from my house. But they are just by default an equity country. I mean, people get stocks when they get born. So there's some divergence there. But what's interesting here is that now there's been zero interest rate for what? I mean, more than a decade. Mm-hmm. And finally, there's a coupon that you can get. We see a number of our very loyal users are trying to capture some bond yield now and lock that in. You know, not necessarily just to have a coupon like decades ago, but more maybe through CLOs. Mm-hmm. That also represent kind of a leveraged opportunity there. How do you see that in terms of risk? Mm-hmm. So I'm not asking you really on the Danish economy. That wouldn't be fair. That would be a very small area for you suddenly to pretend to be an expert in. But where is the risk of these trades that are trying to capture something they've been dreaming about for a long time that might come back to haunt them? I'm not saying that will happen. Yeah. I'm just saying there's risk attached to overcommitment.
Well, let's say if you are talking about risk-free instruments, so let's say you're buying a treasury, okay? So from a credit perspective, you're not taking credit risk, you're taking interest rate risk, okay? So what you should do about it, you should think, if I'm buying a 10-year treasury at 4.4%, what this means is that the bond market is pricing a certain path ahead for Fed funds rates over the next 10 years. You can think of a 10-year bond as the market implied path for Fed funds over the next 10 years, starting today, plus some term premium, okay? So that's the uncertainty that you're paid to hold a 10-year bond with a lot of duration risk because you don't know the path ahead for growth and inflation. It might be very bumpy, and so you want to be paid a bit upfront. The more uncertainty you have, the more term premium, the less uncertainty, the less term premium. But now you're buying at 4.4, which basically means that as we have Fed funds at 5.25 as we speak, you're buying below Fed funds earn, which means you're buying into a market which is already pricing a certain number of cuts, okay? For you to make money with that bond, so if you're interested in the coupon, sure, just buy, go to sleep, and that's fine. In 10 years, you'll have your money back. If you're interested,
nobody pays you for that. If you have fund manager, nobody pays you for that.
I know. If you're asking me how I would look at bonds, I would have to ask myself, where is my view diverging from the market implied path that is already priced in bonds today and from the term premium, which is already priced in bonds today? That is the question. When you have a divergence that is statistically significant and explained by quantitative models and that you can back, not because I woke up in the morning and I have a different idea, then I would consider buying or selling bonds. And I think this is a very simple thing, but it helps people to understand you are not investing in a silo. You are investing against market implied distributions and probabilities that are priced in today's price that you're watching on the screen. So whether you go long or short, it means you have to have a strong idea of what is your expected subjective path. How does it differ from what's priced in, and why does it differ? That's the way I look at bonds. If you're talking about credit, that's a different story, because now you're overlaying on top of the risk-free rate, you're overlaying a credit component. And credit is, you should think of credit as a coincident indicator of economic activity. It's not leading. So credit spreads are tight if the economy is doing fine and everyone is happy. Credit spreads widen right when everybody's freaking out. It doesn't predict anything. It's a life thermometer, basically, of animal spirits and how the economy is doing. So right there is basically like having an equity exposure, but more in the form of selling volatility. So if you go long credit, you are paid as long as nothing happens and fundamentals stay fine or improve. Then you're paid. It's a nice shower of carry and you're paid. But if it's not,
that's the dream scenario. That's what they're hoping for. I mean, that's the dream.
So the risk that you ask there is basically that you have these jump events, these vol events, and if you're long credit, you're short vol. I mean, it's very simple. And when you're going to have these vol events, well, it can wipe out quite a lot of years of carry in a few trading sessions. So that is the balance of risk that people should look at. Yeah. How much am I getting paid in terms of carry to sit on this thing and make it work if nothing is going bad? But what is my risk? What is my jump risk? How much of that carry am I putting at risk if there is a volatility event which surprises my credit position?
So let's try and connect this to one of the other questions, because there's one from Kaya that asks, where do you see a potential black swan event happening next? We have seen a few taking place already, but been quiet since Silicon Valley crisis a year ago. Too quiet.
Yeah.
So one thing here, so if we start in the corner again and on fixed income and credit, do you see anything that you should really put notice on or notice to if you are if you have exposure to credit at this time? So if we go all the way to black swan events, that could have an impact here.
I would say the first answer to this question is, if I could see a black swan, Xander, then it's not a black swan because I could see it before. So that's always an interesting question. If I'd have to guess, what would be an unknown that pops up that is not on the radar of people whatsoever? I would say by now, this is going to sound interesting to many people, but the potential for a short window of deflation in certain economies. So China is experiencing deflation as we speak, for example, okay? There are certain economies that, if caught in a deleveraging event, for example, if the housing market would suffer all of a sudden because it's higher for longer stance would cause reverberation in the housing market, a deleveraging process would start, deflation could temporarily happen in some other developed markets, economies as well. And I think this is something not on the radar of people. So right now the distribution certainly is, everyone assumes inflation will go down to 2, basically in a straight line. The higher for longer tail, as we have shown, right, is a bit, let's say, fatter, but the deflationary tail is non-existent at all. And I think it could happen if there are some reverberations of deleveraging in certain economies. So deflation is something that I would keep an eye on as a potential risk. How does it impact credit? Well, highly leveraged companies, for example, facing deflation are basically seeing the real value of their liabilities going up effectively. So it can be an unfriendly environment for certain credits.
We had back decades ago when I was with Saxo Bank, we started a research publication that they have evolved, and it's the chief economist Sten Jacobsen who has done a tremendous job on that. But it was something we started called the 10 most outrageous predictions, and it was never meant as should have any probability or high probability to be right, but it just made you think differently on market and look at something that actually could happen and that you should be able to reason for it, right? Yeah. And explain that. So it's something I always look forward to. And I think it's also wise, someone like Kaya is asking what could be another black swan event, because There are, of course, they are very unlikely as you described, but if you think closely enough, you can find some that might materialize and that might have this outside opportunity if you could put on a trade related to that. But anyway, thank you very much for the question, Kai, and for your answer, Alf. There's someone who's very kind, maybe speaking Italian. It says grazie.
So, yeah, it says something very, very nice in a very clean Italian. So it's either Google Translate or Piotr is fluent in Italian. As we are heading towards the end of the interview, Soren.
We are.
I mean, we spoke a bit about the fund that I'm launching. So with your permission, may I spend a few words on that?
Yeah, actually, because I really wanted to, again, ask a bit into that. What is the scenario that brings you to come back to asset management now? You mentioned it briefly in the beginning, but it's a stressful life there. And you must be encouraged by something, so please do that.
I would say that the key here is that I expect macro volatility to pick up very aggressively over the next decade, and there are a few reasons. We discussed about demographics change, we discussed about the use of fiscal deficits, the volatility in growth and inflation, the idiosyncratic opportunities around the world. But importantly, I think a global macro allocation is something that in a standard portfolio can really help. Because as we have seen in 2022, if you have a portfolio of bonds, stocks, even if you have commodities and real estate and other stuff, you might end up in years of macro volatility losing money in all assets in your portfolio unless you have strategies that are uncorrelated and that actually benefit from this macro volatility. So if you're going to have more years like that, I think a global macro allocation makes a lot of sense. And, I think there has never been a more exciting moment in my career than to come back with a global macro fund, because look around the world. I mean, look at China, Japan, and Europe, and the US, and so much going on. And I don't think this is going to change. So the time is pretty good. The opportunities are there. Very happy to get this thing started. And the fund has been, basically, I'm preparing it. I'm launching it. The idea is to start trading by later this year. Right now, we are in the early investor interest phase for the fund. And, I'm very happy with the early interest that is coming down. As we speak, in a few weeks, the fund has raised already about 40 million of soft interest, which I'm very happy with. The window is still open.
Congratulations.
Thanks, sir. And the window is still open, of course. I mean, it will last for a few more weeks. The idea there is to speak with interested investors and make sure they understand that if you come in as an early investor, you have quite some preferential fee treatment that you can carry on forever. And also all my macro research from the Macro Compass there, which people pay quite some money for normally, would be given for free to early investors. Because I think, Søren, like, if I can help you with 90% of your portfolio, I mean, you might allocate 10% into my fund. Great. Thank you very much. But if I can help you as well with giving you ideas and a framework to think about how the world is evolving, which affects the remaining 90% of your portfolio, then I should. So the research is free and there are preferential fee treatments. Obviously, the spots are limited. I won't be carrying on this forever. But if people are interested, I'm very, very happy to have a chat with them.
No, and we should also just, when we finish up here, your handle and how best to get in contact with you, Alfonso. Of course, people are also very welcome to reach out to us at Cohera. We'll be happy to put you in contact directly with Alfonso and his team. I think it's a great time to create a fund. I agree with that. I also think that how the market has evolved, so you can put and offer different structures and access to it for a different kind of investors, opens up opportunities for fund managers if they think of it in that framework. So when you decided to come back, I mean, again, you come from an institutional side, you work for ING, you could ask for another job in a bank, but you decided to make your own shop, and connected to the Macro Compass is a great idea. But who do you feel you made the fund for? I mean, who is the ideal investors here? We have seen interest in your fund. I have been talking to a number of family offices that has expressed interest. who is the ideal investor, and who are you speaking to at this point? Because we also know that institutional investors, they come in late. They want 3-year track record, or they want $100 million in a year, whatever. So you build it up over time, and it's not a sprint here. But ideally, where do we start here?
Well, the people listening to this interview, hopefully. So basically the target audience for the fund is built for family offices. The fund is built for high net worth individuals, for entrepreneurs, for people that have accumulated wealth and they want a diversifier in their portfolio. They want an asset class, an allocation into their portfolio that will help them protect drawdowns in standard asset classes when macro volatility is there. So that's what the fund is for. The fund is a complement to your standard allocation that gets you this exposure to macro volatility and all these opportunities in a very nimble way. And I think anywhere from an individual to an entrepreneur to a high net worth to a family office to a small company, they all qualify as potential investors for the fund.
And what are your return targets here? Just to align expectations and volatility, of course, because if you take Brevan Howard, they have returned 1 or 2% over annually over years. So that's a macro fund in itself, or maybe fund of fund. But how what do you target here?
Yeah, so the fund has a target return of double digits on average per year, which doesn't mean that I will be able to do that every year. I wish, I hope, but double digit nominal return per year is the target by taking a 10 to 12% annualized ex ante volatility. So roughly you can think of 10-12% vol, 10-12% target return. This is your typical macro fund trying to make a shop of one, trying to also not be correlated to equity markets for sure, and also trying not to be correlated to directional bond markets. So this is supposed to be an asset class you put in your portfolio with no correlation to standard betas, equities and fixed income, because it's structured its trades by looking at discrepancies, relative value opportunities, idiosyncrasies, uses options, and therefore it generates, hopefully, thanks to macro vol as well, a stream of return which is in the double digit area and uncorrelated to standard beta.
And your fund, where's that domicile? Have you decided on that?
Yeah, so I'm in the Netherlands, and the fund is regulated by the UK Financial Conduct Authority because the fund is hosted under the umbrella of a UK Norwegian asset management company that has trading licenses, and it's a regulated entity. So I will be operating under their umbrella. The fund is audited by PwC. Prime broker is Morgan Stanley. There is a fund administrator, of course. There is a custodian bank. The entire infrastructure is super institutional, tier one names in there. So I made sure that is taken care of because my max attention should be devolved to running strategies and making sure that my best effort is for LPs mostly.
Fantastic. Okay. Congratulations with this new journey, and keep us and investors informed well during the process. If there's anyone of our viewers or that would like to have more information about that, or if there's some questions we haven't addressed, please reach out to us directly to Alfonso. Which is the best place to find you beside your Twitter handle that will probably
So I'm going to write it in the chat here. This is the email address of the fund in case you have any inquiries. It's fund@themacrocompass.com. Of course, you can contact as well Søren and the Cohera team, but if you want to send an email, you can directly do that at fund@themacrocompass.com, and I will be replying. There is a memo that explains the strategy of the fund, the target risk and the returns and everything. You can just reach out and you can have a chat with me. I'm super approachable. I am a guy, I like to talk to people. I think the LPs in a fund should be people that really believe and understand what the strategy is about. Very approachable person, guys. So if you're interested in hearing about the fund, just shoot an email or talk to Søren and he will direct you to me.
I'll be happy to do that. And I think that you're onto something significant. And I think that next level of being a fund manager require that you have this openness and you have this ongoing dialogue both with your investors, but also sharing your research, where you are and what's really inside your portfolio. I think it's the way to capture the attention and commitment and the fiduciary responsibility, to be honest. I think that has been overseen for quite some time. I'm glad that it's someone like you that who likes to talk. Let's put it that way.
Yeah, I mean, it's a relationship with somebody who's trying to manage your money in a responsible way and applying strategies. You should be as open and crystal clear with you as possible. That's why you also receive my research. You're supposed to know what am I thinking at any point in time. It's part of the added value I can deliver for people, and I plan to keep it that way.
Fantastic. Thank you so much for your time today, Alf. We have more discussions coming over the years, and I'm looking forward to it. So have a great day, and thank you for everybody for tuning in. We'll distribute the replay as well. There will also come highlights. It comes with all our interviews. So we'll be back soon, and have a great day.